Welcome, welcome, welcome. Good afternoon. I hope everyone is settling in. We'll give everybody about 30 more seconds. We still see a few people popping in, and hopefully you were able to hear a little bit of the tunes of Sam Cooke as we showered in one of his favorite songs, A Change Gonna Come. So we'll get started in just a minute or so. And as you get your mind, I'll say, right for this time that we have together, I hope that this next hour is one where you can relax a bit. I'm sure some of you are at the lunch hour, and some of you on our West Coast are almost there. Okay, that minute goes by very quickly. So welcome and good afternoon. My name is Sharice Conanan Johnson, and you are now at the Open for Business, How Philanthropy and Investors Can Dismantle a Broken Small Business Infrastructure webinar series. This is day one of 2 days that are open to the public, in which we will be talking about this broken small business infrastructure, as well as what can we do to fix it. Tomorrow's session, which will start at the exact same time, will focus on the role that funders can play specifically. And so first of all, I come to you with a spirit of gratitude on behalf of the full Next Street family and on behalf of the panelists that are here with us today, as we have this very important conversation. For those of you familiar with Next Street, this will be a repeat for you, but for those of you who might be new, Next Street is a mission-driven firm, and we are all aiming to mobilize how capital and how customers and how quality services get to small businesses and entrepreneurs, particularly those that have been systemically held back. And we're bringing you all together such that we can talk about how philanthropy and how all of the various stakeholders can create also today an equitable entrepreneurial ecosystem. This is underrooted in a belief that we do think that the small business infrastructure, and when I say infrastructure, I mean not only the small businesses and entrepreneurs, but also the institutions across the spectrum, corporate, government, business service organizations, and of course, philanthropy can all support those. I want to share with you a few statistics that highlight why we believe the small business infrastructure is broken. And I'll orient you to the top half of this page for those of you viewing the screen. We know that nationally, white entrepreneurs attract 17 times more equity capital than Black and Hispanic entrepreneurs. We also know that Black business owners are approved for financing at 1/3 the rate of their white business owner counterparts. And we do know that business owners of color are half as likely to use mainstream financial institutions. And when we think about some of the capital specifically, less than 1% of venture capital funding nationally goes to Black founders. And we just had one of the most pressing amounts of dollars come out over the last year and a half. We also know from the data that only 2% of SBA funding historically reaches Black-owned businesses, and 5% of SBA funding historically reaches Hispanic-owned businesses. When you combine that with what has happened with the Paycheck Protection Program last year, particularly during the height of COVID, Black-owned businesses were 5 times more likely to not receive funding than white-owned businesses. So we do know that the stats point to this brokenness that exists within the infrastructure as it relates to broken channels of distribution, as also as it relates to capital and some of the services that are provided. However, there is opportunity. And for this, we know that small businesses and entrepreneurship, the net worth of their families overall is 5 times the net worth of families that don't have an entrepreneur. And for business owners of color, that number is 10 to 12 times as great. So what does that mean for us? It means that entrepreneurship as a lever to create net worth or wealth is super important. And what we've seen over the last 12 months, particularly since July 2020, applications for small business licenses have been up over 50% from pre-pandemic levels. And so within those new entrepreneurs, the rates for new entrepreneurship among Black, Asian, and Hispanic Americans were at all-time highs relative to white Americans. So I just wanted everybody to be rooted in some of the data that's really important to making sure not just the brokenness of the infrastructure, but also therein the opportunity. And so, again, today we're going to be talking about equitable entrepreneurship. I want to ground us also what equitable means. And so you might have heard the term, but just so that, again, we're all on the same page, equitable is providing access to opportunities, resources, and support for communities of color by intentionally recognizing and eliminating historical barriers and recognizing current needs, contexts, and situations. The condition that would be achieved is one's racial identity no longer predicted in a statistical sense how one fares. When we use the term, we are thinking about it as one part of racial justice. And thus, we also include work to address root causes of inequities, not just their manifestation. This includes elimination of policies, practices, attitudes, and cultural messages that reinforce differential outcomes by race or fail to eliminate them. And with that, that grounding, I want to take us to a quick poll. You are all out here, and I see some comments in the chat about these statistics. And so this is good grounding, but I want to put a question for you. And so I'm going to ask to run this poll. What do you think? And I know there are some choices here that you might want to choose more than one, but I'm going to limit you to one. What is the biggest challenge, the biggest one that you see to building an equitable entrepreneur ecosystem? Don't be shy. I want you to fill out this poll because it'll give us a sense of where your mindset is in terms of the biggest challenge to building an equitable entrepreneur ecosystem. I'll give you 5 seconds, 4 seconds, 3 seconds, fill it in, 2 seconds, 1. Katie, let's show the results of this poll, and you'll see, wow, access to capital, 47%, the biggest one, followed by lack of coordination within an ecosystem, and then lack of a comprehensive place-based strategy, and then less so, but still we had some votes for customers and access to quality services. Thank you for your participation. This is very insightful, particularly as we have this conversation about what it means to build an equitable entrepreneur ecosystem. And so with that, we'll have now the opportunity to meet our esteemed panel. And so we are very lucky today to have Stella Ashalu, CEO and founder of WeSolve and co-founder of Fifth Star Funds, Thaddeus Fair, Assistant Director of the Fund Manager for Living Cities, Maggie Kellogg, Business Analyst Manager at Starbucks, and Darren Reedus, Senior Vice President at the Cincinnati U.S. Regional Chamber of Commerce, and also in a dual role as the CEO of the Minority Business Accelerator. And so with that, I'm going to kick off this panel and leave it to them. But by and large, this first question, which I think will provide good grounding for everyone to share with you all about their experiences. But panel, if you can describe your work and what is one, I know you have several, but what is one of the most impactful things as defined by you are doing to build an equitable ecosystem? And I'm going to start with Stella.
Thank you, Charisse. So as Charisse mentioned, I am the CEO and founder of a company called WeSolve. And WeSolve is a platform that connects companies to more diverse candidates and then uses performance data from actual projects to identify the skills and competencies of candidates to identify the best hires and ultimately reduce bias in the hiring process. I'm also a co-founder and investor at FitStar Funds, which is a fund, philanthropic fund specifically focused on the earliest stage Black founders here in Chicago at the friends and family round, where the wealth gap has been the biggest hindrance to Black founders getting out there and starting their own companies, and the lack of access to that initial startup capital. I think those in a nutshell are kind of what I am personally doing to create a more equitable system. I know you said one, but they're both interconnected. FitStar is a result of my lived experience. Being one of the most educated Black folks, privileged, accessed, and the difficulties that I experienced building my own company, and realizing that the model and the system is completely and fundamentally flawed and has obstacles that Black founders face. We are creating a system to assess and evaluate these founders that take those obstacles and unique challenges into consideration, and creating transparency and objectivity in that process.
Fantastic. Thanks so much, Stella. Darren, I'm going to kick it over to you.
Excellent. Thank you, Cherise. So the Minority Business Accelerator is now in its 18th year at the Cincinnati Chamber. Was created to accelerate sizable African-American and Hispanic firms and also diversify the supply chains of our corporate community. Importantly, this work was birthed from the civil unrest that our region experienced back in 2001. It has since gone on to be recognized on a number of platforms as a national best practice. And so we're very excited about just the work, much more work yet to be done, but and where we have come to date. Importantly, when we say grow sizable minority firms, to be a part of our accelerator, the company has to have at least $1 million in annual revenue, a B2B or B2G platform, as well as the desire on the part of the entrepreneur to scale further, meaning that some entrepreneurs get to $1 million in revenue or so and provides a nice lifestyle for themselves, which is fantastic. We were looking for entrepreneurs, however, that really wanted to become multi-million-dollar companies. We have since sort of expanded our model to represent 4 fundamental pillars that we call grow, build, attract, create. And I'll summarize this very quickly. Grow is just our historical work continuing forward. Let's grow our current companies of size to their next level. Our build pillar is building a pipeline of emerging minority-owned firms that are under that $1 million threshold, but we believe have high growth potential. What we do in that pillar real quickly is that the very same wraparound services that typically tech entrepreneurs received in the mainstream ecosystem that prepares them for angel and venture capital, et cetera, we bring that same sort of assistance to high growth, not necessarily high tech, who need that very same set of services. Our attract pillar is trying to attract larger minority firms to our region and gaps where we don't have them. And finally, our create pillar, which also leads into the one most impactful thing that Cherise asked me to speak to. Our create pillar is creating minority-owned firms through the acquisition of mainstream or non-minority firms, if you will, with no succession plan, no kids in the company interested in taking it over, aging business owner, and how can we prepare minority entrepreneurs to acquire existing companies of which, depending on the report that one reads, there are trillions of dollars in play across the country in small to mid-cap companies, aging business owners, no succession plan. So we're launching actually a fund to also invest in the acquisitions and support of creating, again, minority firms through acquisition. It's industry agnostic, but one area of focus is manufacturing in this acquisition bucket. Think about the reality of manufacturing as a capital intensive sector, heavy equipment, heavy machinery, et cetera, overlaid against historical lack of access to capital for people of color. Of course, you're not going to see a lot of minority owned manufacturing firms in today's landscape. but what a phenomenal opportunity to acquire into those industries as the current ownership, again, ages out and kids don't want to run those plants, et cetera. And so we're super excited about that and happy to dig in and unpack various aspects of this as we have our broader conversation.
Thanks so much, Darren. Maggie, I'll kick it over to you.
Thanks, Charisse. Hi, everyone. I'm Maggie. As Charisse said, I'm a manager on the capital markets team at Starbucks in our treasury department. So I'll just start by saying that over the years, Starbucks has engaged in quite a wide variety of activities to try to demonstrate our commitment to doing good in the communities we serve. And so specifically from a treasury perspective, there's a lot that we do to try to reflect those broader corporate-wide social and environmental goals into our cash management activities, both on the investing side where we incorporate certain ESG or impact investments into our portfolio, as well as on the financing side through our issuances of sustainability bonds. And so there's one initiative in particular on the investing side that I'd like to highlight today as one of the most impactful initiatives we're undertaking to try to contribute to building this more equitable ecosystem. And that's our Community Resilience Fund. The CRF launched earlier this year, almost a full year ago. It's a $100 million nationwide commitment into CDFIs, or community development financial institutions. And those are mission-driven lenders that work to expand economic opportunity in low-income communities by providing access to financial products and services, usually alongside ongoing mentorship and technical assistance. And so this initiative, the Community Resilience Fund, this builds off of some earlier work, earlier collaborations and partnerships we've formed with CDFIs, especially a pilot program of sorts we did in November of 2019. That was a $10 million commitment and investments into 4 CDFIs in the Chicago area. This time, however, really kind of building off of that work, building off of what we learned, we're focused a lot more specifically and intentionally on the types of impacts we're looking to have, namely advancing racial equity and environmental resilience. And so really given that first goal of advancing racial equity, that's one of the key reasons we're excited to be working with CDFIs again, given that the majority of CDFI borrowers are people of color. Even with that being the case, we're still trying to be really thoughtful as we start making these investments, trying to do a lot of work to really help us find, identify, and ultimately hopefully partner with those CDFIs whose work really most closely aligns with those goals.
Thanks so much, Maggie. And last but certainly not least, Thaddeus, over to you.
Thanks, Reese. Thaddeus Fair, I'm Assistant Director of Fund Manager for Living Cities. A bit about our company. Living Cities is a consortium of 19 of the largest financial institutions and foundations working to close racial income and wealth gaps. We have 2 lines of business that we kind of try to get at that problem through. One, a public sector practice where we look to effectuate policy changes in city and local municipal governments centered around that REI goal. And 2, the social impact investment firm where my team sits, we manage 2 investment funds, also focused on REI. Our first fund, they're both of them about $40 million structured debt funds. The first fund was focused on affordable housing and community revitalization, some CDFI support and the like. And then our second fund was open to sort of follow on the mission of the first fund and kind of carry forward some of the lessons learned and areas that we continue to want to focus on. What makes Living Cities unique is that in 2018 we went through a firm-wide shift to focus exclusively on racial equity and inclusion as a thesis that will cut across all of our lines of business. So what that meant for the policy team was a little bit of changes around what they wanted to focus on, some intentionality around municipalities, and then on our investment team, it meant tossing out the pipeline that we had, originating a new pipeline focused on REI and things we wanted to interrogate and explore in that thesis. We're in the process of launching a third investment vehicle as well to carry forward some of the ideas that we came up with and we found successful in our second fund. And so we're super excited about the opportunity to kind of to continue to create proof points to our things that kind of get around closing racial and wealth gaps.
Fantastic. Thanks, Thaddeus. I mean, from what you all have said, I hear the common theme around racial equity, a focus on race, and obviously that's a big part of what we're talking about today. I also hear, just picking off of Thaddeus's recent comment around interrogation, right? Throwing out the old, trying to come up with something new. I want to kick back to the entrepreneur, more entrepreneurs on the call, and that's Stella and Darren, because Darren, you work with so many entrepreneurs as well. And I want to ask you, because often your voice is not as prominent in some of these system level conversations, but I want to make sure that it is. What should the goal of various institutions, and we have those represented here, philanthropy, corporate, government, financial institutions, be to support the BIPOC entrepreneurial and small business community, and why? And perhaps, Stella, we can start with you on that one.
Yeah, sure. I think this is a fairly large question, as far as the goal, but I think it starts with truly understanding the root of the challenges and the problems that affect or that cause us to not have an equitable system of distributing capital and for folks to be able to thrive and build companies and for entrepreneurship opportunities to be equally dispersed. I think so often, I'm an entrepreneur. When I think about problem solving, any problem, it's really what are the fundamental root causes of that problem. Without fully understanding those, I think it's it's really hard to create a solution that effectively addresses the challenges without introducing other, ancillary or unintended consequences. So I think, with my personal experience, working to build an enterprise, and also just the work that I've done in the Chicago community with other founders of color, really understanding those key challenges that we face, some fundamental with just the systems, the capitalist systems of venture and how venture funds distribute capital. Understanding the lack of access and why certain groups or demographics have less access. And even when they are given access, what are the other barriers and challenges they face? Because the solutions then become unique to those populations. Specifically thinking about the work that we're doing at FitStar Fund, we know that these founders have different experiences, different circumstances than a lot of their peers and their counterparts, their white counterparts. So how can we uniquely address those, but also while still assessing them for the qualities and the characteristics that ultimately signal success or mean that with the right resources and support can have success. And so in a nutshell, it's really, the goal should be truly understanding the core or the crux of the issue, I think, before jumping into creating solutions, just as any entrepreneur or solution provider would be expected to do.
Yeah, I love that. I love that perspective, and thank you for bringing that entrepreneur mindset here. Darren, do you want to add or take a different approach?
Absolutely. Thank you. This is a particular question I've spent a lot of time in over the years, and I want to build on Stella's point about fundamental root causes. And so I've had the good fortune of doing a lot of work in, let's just call it mainstream entrepreneurial ecosystems, and examining the various players of an ecosystem, whether it's the tech accelerators themselves or offices of tech commercialization at universities or research labs or angel funds and angel networks, and I can go on and on. And when we think about, again, back to fundamental root causes, what I think often gets missed is the fact that sadly, but importantly, we are not that far removed but from separate but equal being constitutional law in the United States, right? And so when you think about our purposeful desegregation and integration, starting, with the school system and busing and such, that's not ancient history, that's within my lifetime, right? And so we think about then intentionally integrating capital networks and venture and private equity networks. When I have examined the natural reality of how we all do business and networks and relationships that we know and trust, which flies in the face of inclusion, which means you have to build new relationships and build new networks. And so when I think about, to your question, the role that corporations and philanthropy and such can play, who are often funding and resourcing the mainstream players in the ecosystem, as how do we think about incentivizing new behaviors, incentivizing, so when it's time, for example, for us to, whether it's providing a grant or support to an organization, what are the metrics we're holding an organization accountable to around the number of women and minority firms that they're supporting, the number of people of color that are on the management teams of emerging companies, or on the boards, or participating in angel networks. And so we can incentivize different behaviors. In fact, my humble opinion, we have to, because it's an unnatural act. We're all busy, we're all running in a million different directions. And so again, back to the reality of, I'm gonna do, when I've got deadlines to hit, and I'm that accelerator, or I'm that angel fund, or what have you, I'm gonna go to the networks that I know, and there's nothing wrong with that, but it kind of flies in the face of inclusion. So to encourage organizations to build new relationships with those of us on the phone and many others that are touching a very different audience than many of these organizations are. And it's through that sort of purposeful integration that we'll see more of an organic play. You don't need to look much further than just all the typical roles that are played in an ecosystem. And I mentioned a few, the investors and subject matter experts helping to make investment decisions. Way more people of color could be participating in that if they were connected to and aware of that work. And so I think incentivizing different behaviors would be a tremendous goal that philanthropy and corporations and such could play to just spark new activities and behaviors in the ecosystem.
Fantastic. I love what you said, Darren, particularly about that incentivizing piece and new behaviors and new relationships. And so I want to give, because Thaddeus and Maggie represent, larger corporations and foundations and financial institutions. One, I want you can respond to anything that Darren or Stella has mentioned, and whether or not you agree or disagree with it. And I want you to share more detail. You talked about the shift in your own organizations, right? There have been a lot of commitments made for racial justice and to fighting racism. What specifically has changed internally at your organization? What was needed for some of the buy-in to make that shift? And what can you point to some of the examples that you think will make this sustainable? Quite frankly, a lot of people think that this is just a moment in time and we're going to revert back. And so sustainability is really important. So I'm going to this time ask Maggie to go first, and then Thaddeus after that. And Maggie, even before you jump in, for the audience, if there are questions that you have from what you've already heard, or as the panel continues to speak, please pop them in the chat. We want to make sure that after some of these other questions, we get to your questions as well. So pop them in the chat, or if there's a comment that's been said that really resonates with you, pop it in the chat so this panel can get excited about what they have been talking about. So Maggie, over to you.
Great, thanks, Therese. So yes, completely agree with everything that that Stella and Darren said. In particular, as you mentioned, Therese, the incentives part, I think is really, really crucial. And, of course, as Stella said, really getting at the crux of the issue, the underlying causes as much as possible. So, yes, nothing to add, just, want to reiterate that I completely agree. But yes, to answer your other question, Sharice, like I said earlier, Starbucks has tried to do quite a lot over the years to try to generate positive impacts for our stakeholders and the communities we serve. But throughout our history of doing that, we've really looked for ways to improve how we do this work, as well as look for new ways to go about doing this. I think Thaddeus was talking about this earlier, sort of this continuous improvement kind of aspect of all of this work, and or I guess in the interrogation piece was really what he was getting at. So really continuing to kind of interrogate it as we go. But yes, I personally feel very humbled and grateful to work for a company that prioritizes this kind of work and allows for individuals like me in a corporate treasury department the opportunity to contribute to these efforts. So there's a lot of enthusiasm and support for these efforts internally, and so that hasn't changed. That's really stayed a constant over the years. But what has changed, again, kind of going with that theme of interrogation, kind of continuing to take a critical lens and incorporating new knowledge, that's learned or gained or circulated in this ongoing discourse about these issues, to improve our understanding of really the crux of the issues, as Stella was getting at. As we continue that interrogation, what has changed is our understanding of the underlying issues, where we should focus our efforts, how we can and should go about trying to generate these positive impacts in our communities, and helping to build this equitable ecosystem. And so for us, this focus on racial equity, that really became the focus for many corporates last year, especially after the murder of George Floyd, the widespread demonstrations and critical discourse that ensued after that. And even before that, of course, there's all sorts of horrible instances we can point to that that spark this kind of discourse. But in particular at Starbucks, there is an incident at a store in Philadelphia in which 2 Black men were arrested, and that sparked a great deal of justified outrage. And so these and other events in recent years have really led us to more specifically and intentionally focus on advancing racial equity. And so that's why that's really a core goal of our Community Resilience Fund, as well as some other issues that are happening kind of across other teams across Starbucks.
Fantastic. Thanks, Maggie, and thank you for bringing up that example and kind of owning that. Thaddeus, what do you have to say on this point in regard to what is really needed for that buy-in, that change, and to really move in the direction that you all have seen to at least start?
I think from our perspective, the big thing that we did internally was make that early shift into REI, and the getting the buy-in from our founders and our investors that sort of bought into a different mission. And then there were some that wanted to opt for a race neutral thesis that we felt was incongruous with advancing racial equity. So we had to be willing to say, hey, if we want to do this, that means maybe we leave commitments on the table that we would otherwise get in our funds. One thing that we do that I'm super proud of that we are able to do is we're able to push the risk envelope and be catalytic with what we do in deal structures and where we will go into investments. And I think so in the $1 trillion capital markets arena, our funds are relatively small in terms of assets under management, so we don't really move any needles there, right? But what we do is we'll come into an investment as a first mover or anchor. We have a kind of an internal joke that the investment arena is much like a middle school dance, and someone wants to get on the dance floor, but someone has to jump in on that floor first, and then all of a sudden you've got a party, right? But so we're very happy to come in as first mover and take first mover risk, sort of de-risk what is the risk profile for a transaction. And where I think we get our biggest win is when we have one of our investor partners or foundations or members organizations follow us into deals with larger checks. And they'll say, hey, we understand that we see this crack at this. They're an anchor investor. We think this is risky, but we're following your diligence, and you kind of disproved our thesis, and now we believe in it, so you want to support it, and we believe it is investable and ought to be challenged. And so that's where I think we get our Superman powers, if you will. And just the follow on that, we have a very intent way of discussing racial equity in America in our company. We're not afraid to kind of ask tough questions, even if it leads to tough answers, and say, hey, these are the facts, and what are we going to do to change this, and also evolve as an organization. I think we were one of the first organizations to kind of move to an REI thesis, and now in our second fund, we have a portfolio of investments that it's REI themed, and we wouldn't have had if we weren't able to secure buy-in and let our have our investors let us change our investment thesis from the TOD type of thesis that was before to REI. And so I think that's where we kind of win a lot of battles, is getting our investors and founders, and even ironically banks that have kind of perpetrated some of the REI issues, have gone in and said, hey, we got this wrong, and we believe in it now. I think the last thing I want to highlight is we don't always get things right. So the interrogation part is big. So sometimes we have the best intentions in a deal or in a transaction, and it was like, hey, this is what we thought was going to happen. This was the actual outcome. That was not the intent. And so we're happy as we share our wins to share our losses and like what we've learned. Like say, hey, we got this structure right, or we got this idea right, or this idea was catalytic and did what we were supposed to do, and here's what we got wrong. And so that if anybody else is in the space trying to have the same impact pieces that we are, here's what we're very happy to air the dirty laundry of, hey, this did not work. If you're trying this, don't try it this way, maybe try it a different way. And we're also happy to celebrate our wins, which I think is critically important, to not have this era of everyone in the investment space always gets it right, no matter the well-intentioned investor.
Thanks for that, particularly on the last piece you said too, the vulnerability of acknowledging you don't always get things right, and really thinking about things from a learning perspective. And so appreciate that. So my last question, and then I want to definitely there's some very juicy questions in the chat. So we're going to get to those soon. So panel, you can take a peek so you can get ready, but I'm going to pull through them. But before then, I just want to have one more question to sort of round us out here. And I think you all touched on some of these aspects a little bit, but I want to dig deeper. At Next Street, we've done work to help build equitable ecosystems in over 25 cities around the country, from east to west and everything in between. And sometimes we observe that system players, or the folks that make up the infrastructure as we've been defining it, come across or can actually be very extractive to BIPOC small businesses and the community that they are trying to serve, or fund the same players, meaning that the same dollars are going to the same folks, or only thinking about intermediaries as one piece of the puzzle. I want to ask you, and if you have any recommendations, particularly for the audience, how do we, and how would you encourage us to think about striking the right balance in funding or resources to existing players versus new innovations that are sprouting out each day, and also at the same time, not being extractive in the process? And I'm going to leave this one open. If anyone wants to jump in there, I'm not going to call on you, but I'm just going to allow you all to jump on in. So I'm going to leave it open.
I'll jump in, Charisse. So juicy question. And so I would say that, again, I guess from an ecosystem perspective, city to city to city, you have your sort of mainstream intermediaries and recognized players and organizations that are fundamentally leading the charge in these economic development and entrepreneurship spaces. And so, so one is making sure that these leading organizations, to my earlier point about incentivizing behaviors, it's not as if, broadly speaking, we don't recognize what the fundamental sort of metrics are to create success. As we start tracking, whether it's the number of entrepreneurs being supported, capital raised, jobs created, and all the standard metrics that kind of go along with that. But what we're not measuring, in my opinion, is if I start thinking about the activities that lead to those outcomes and metrics, something even as basic as when a lot of these intermediaries and such are putting on events, and what partners, particularly partners in underrepresented communities, are they putting on those events with? Through what media channels are they communicating those events? It's not accidental that you go to most of these events and you don't see a lot of diversity in terms of the attendees and such, because they're not really being communicated, partnered, and promoted and through diverse networks. And so when you start, again, looking at when it's time for the typical players to find management talent to commercialize the business, well, the hunt for that talent happens in networks that are not diverse. And so you can kind of pick apart every activity that leads to outcomes and just infuse. This is my point about incentivizing behaviors. And so when you ask organizations, well, how are you going about doing what you do? You can incentivize a different set of outcomes by incentivizing different activities. And I think that from an ecosystem standpoint, kind of just gets at the heart of the day-to-day activity. And by design, then you'll capture a lot of, to your earlier point about how do you strike that balance between the mainstream organizations and new ones coming along. If the mainstream was incentivized to broaden their networks, they would capture those emerging ones coming along, because they'd have to kind of reach different audiences and such. And so very fundamental at its core, but that's not easy work. And that's why, in my opinion, it needs to be incentivized.
Right. Go ahead, Stella. I see you're going to get in there.
I think, Darren hit the nail right on the head as far as, his response. And just to kind of, add on to that, I think the decision about, incumbents versus, the new players, and where do you strike the balance between how capital is distributed or resources are distributed to make these changes? I think it's really about creating a framework, an effective framework that actually evaluates and pressure tests a lot of the different systems or factors at play. So things like the decision makers who are in the room. How do we have a framework for identifying who are the folks making these decisions? And does that represent the ultimate change or the impact that we're looking to have, the diversity, the equitable access that you're looking to make? The process around, for instance, talent acquisition or assessment, are there frameworks that allow you to have more objective and telling metrics or ways to assess how you are doing in that area and creating equitable, positive change? And with those types of frameworks, you can evaluate the existing players as well as new players, and those decisions should, or the outcomes of those, of that process should really determine where resources and capital are being given. I think when that's done, to Darren's point, it will incentivize the existing, known folks to adjust and change to make sure that they're being able to compete with the new folks that are creating, innovative solutions or ideas to address the problem. And it will ultimately ensure that the new organizations that come out are looking to create metrics that beat, if not match, if not beat those existing players. And so to speak, incentivizing the actual outcomes and the metrics that we're looking to see. I think without having some sort of existing or transparent and effective framework to evaluate and pressure test these systems, we won't really know where capital and resources should be dispersed.
Thank you. I think Darren and Stella, you both really hit the mark. And I see, Maggie, you want to get in there. Go ahead and get in. Do you want to get in?
Sure. I was just going to build off of Stella's response, just in terms of frameworks and trying to look at this in an objective way as much as possible. That's something we've at least put a lot of thought and effort to try to do at Starbucks with our community resilience fund, as well as, I'm sure other teams throughout the organization are also trying to do things in a similarly systematic and unbiased way as much as possible. So at least with the community resilience fund, just wanted to add that we are trying to be as rigorous as we can to, set up some processes and frameworks, as Stella said, to really try to review and select organizations who, most closely, as I said before, most closely align with the types of impacts that we're trying to have. And so again, we're really excited to be partnering with CDFIs as our primary investment partners through the Community Resilience Fund, in part because of their wraparound support services, but also, as I mentioned, on average, the majority of people they serve are people of color. So, but even beyond that, we're really trying to take steps to look as closely as we can, do our best to select partners for investments that do most closely align with these goals. And so on the racial equity side, one of the key things we're looking at is that proportion of borrowers, of a CDFI's borrowers who are people of color, as well as looking at whether the CDFI itself is a diverse organization across its staff, leadership, and board of directors. Are those groups comprised of individuals who generally reflect the communities that those organizations are trying to serve? So, it's hard work, and we definitely don't have perfect processes in place to do this, but yes, we are trying, and I think that's just part of the continuous improvement and work to interrogate this as we go, to just learn and improve as we go.
Great. And I'm gonna move us now, given that strong foundation around what's needed and what the metrics that you are looking for. There was a juicy question in the chat, and Thaddeus, I'm going to put you on the spot here because I want you to dig in here. It says over the past few years, and this is from Topolton, I hope I pronounced your name correctly, Gomez. We've seen these bold commitments from corporations to racial equity that Maggie was just explaining to you from the Starbucks perspective. From what you've been seeing, and perhaps from what you get from all of the partners that you work with, Thaddeus and Maggie, if you want to get in here too after this, please do. What results do you think corporations, and I'll broaden this to philanthropy, need to see in order for them to up their investments? And the number here is quoted 10 times. Like, so how do we get more money based on the metrics that we'll see toward equitable entrepreneurship? And I think implying too that even the commitments that we've seen still aren't enough. So Thaddeus, do you want to take a crack at that one? And Brittany, I will say, Brittany Morgan tagged on, and to shift corporate commitments from saddling consumers with additional debt loan products and real capital distribution. I know, it's hefty.
That's a big question, and one that we all of our investors are foundations and banks. So we ask them this question all the time, frankly. And there's one other question that was before that asked, how do you change the paradigm of the collateral guarantee act that prevents access to capital? That's one thing I want to touch on that we've uncovered in our fund as we've deployed our capital. The big one for the commitments is there's new intentionality around how the foundations are starting to deploy capital and starting to understand capital and with the intentionality around race. There's one bit of legislation that kind of it's intended to kind of keep banks from themselves or like save them from themselves, where like you can't make commitments based on race. And that prevents them from saying, hey, I cannot deny a BIPOC founder a loan based on race. But it also means that they can't direct, they're limited into how they direct capital into other companies that would do that. And so there's this new kind of, I was on a panel about a month ago, there's this new thought about how do we add race into like the Community Investment Act requirements that banks have to meet. How do we make that as a charitable intent where they can say, I want to invest only in Black founders or BIPOC founders or and the like. And some of the foundations are starting to move towards solving this collateral guarantee, where they're starting to put up what's called first loss capital or guarantees themselves, and saying, hey, the whole idea about the racial income and wealth gap is that most people that are in that group don't have the friends and family relationship of, or we call it the katana, like the golf course community of friends that are rich and will give them $1 million to start a company for some dream they have, right? And so when you're going to be slow to change the banking paradigm of we won't lend you 100% of the capital to start your business. And I think that there's some argument that can happen there, but what's starting to change is the foundations are coming and saying, hey, we'll put up $1 million as a guarantee. And if things go awry, like our money's on the line, and we're a big enough foundation where we can take that hit. Whereas it's and with the idea that getting capital into the hands of people of color gets people of color into that seat to make the different capital allocation decisions. So that's something we've seen in a couple of funds that we have done. We did an investment where we were willing to say, hey, we'll write you a $500,000 loan to use as your co-investment equity in something you want to do. So there's a big movement in that, and something that we're starting to share out of this is how you close that REI gap by removing that barrier to entry that is co-investment capital, that is startup capital, that is like what banks and investment firms consider skin in the game for the investors. And I think that's where the market is going to move, if I had to be daring and make that prediction. But I think that's where the market is going to have to move, because if you want to close this gap by creating wealth, you've got to deal with the fact that race and intentionality and access to capital and wealth generation and wealth creation have been barriers of entry to communities of color.
Thank you. Thank you for taking that meaty question and bold one. Appreciate that. And so we're about 5 minutes to the end of this hour, which has gone by super quickly. Still plenty of questions in the chat, but I'm going to focus this last question, and I'd like each of the panelists to maybe spend just 30 seconds as we kind of wrap up this panel. That was super insightful. But and this one's from Darlene, which I think is really insightful. Darlene Crane, thank you. And it says, what are the innovations to make sure we bring the voices and experiences of owners and entrepreneurs into shaping organizations? So that's the one I want to leave with. I see Stella smiling. Maybe, Stella, you want to kick us off here in a 30-second roundup, because this is going to help us get to an equitable entrepreneur ecosystem.
That was actually a smile of great question, and I do need a second to think about it if I want to give a thoughtful, impactful answer. So I'll pass it on to one of the other esteemed panelists to jump at that one, if that's okay.
That's totally great. We're all friends here, so they're gonna. I know somebody's gonna step up and help out here.
Yeah, I'm happy to kind of jump in, and I may take a panelist liberty to somewhat broaden innovation, if you will. I agree, it's a great question. What I see as just systemic and problematic is also the fact that, which ties directly into innovation, this disproportionate focus for entrepreneurs of color, when we talk about these solutions and strategies, that so often, whether it be historically, in many cases still today, this focus on debt versus equity. And so entrepreneurs of color are debt heavy and equity light. And so equity capital by design is risk-based, where debt is risk averse. Equity capital by design is looking for innovative, high potential models. And we don't, in my opinion, do enough for whether it's early stage all the way to later stage private equity, and really driving deeper understandings and connectivity for entrepreneurs of color around the equity capital markets. They have never really been intentionally integrated. And so, and when there's economic downturns, entrepreneurs of color disproportionately suffer because, again, debt has to get repaid no matter what the economy is doing. You still have to make those loan payments. Equity capital is a different animal. And just equity and debt are just night and day different instruments. And equity leads the way, in my opinion, to greater innovation.
Thank you, Darren. Started us off very well. 30 seconds for Maggie, Stella, or Thaddeus.
To piggyback on what Darren said, I think we, as an investment community, have to be more intentional about investment products, and because he's right, the equities is almost sometimes better than debt, because you're not solving for cash flow issues in early stage businesses where the growth is somewhat tenuous. One thing that we've kind of looked at too is sometimes equity terms can be extractive, and so there's a balance between sometimes debt is done with intentionality to avoid being extractive, but it doesn't always get it right, because then you have the other cash flow issue of now you have these massive interest payments and you're forcing economic events that don't necessarily have to be organic because you need an exit as a lender. There's another innovation that's happening in the field now. It's called revenue-based financing, that is kind of trying to bridge the gap between the two, where instead of it's equity-like financing in the sense that your cash flows are varied based on the revenue of the company, but you only make money as the investor, as the company makes money, and it's not as punitive in terms of extraction and current cash flow. And I think we need to do more of that and be more intentional about how we direct equity to these types of investments without the onerous terms that they can come almost be nefarious by design, that are sometimes with intent. It's not that we all do the best things. Maybe the impact space we try to, but try to be more intentional about the way we structure our equity investments, so that they're not overly punitive or not taking too much of the founder equity out of the table that is going to be the wealth innovation vehicle.
Thank you, Thaddeus. Stella, last comment.
So I spout a little bit about this question because, through the work that I do at 1871 in the Chicago community, I've been privileged to be in a lot of these conversations by, large organizations, funds, firms looking to create some sort of equitable impact or change through capital. And when I think about innovation, folks usually think it's something new, tech-related, sexy, but innovation can be as basic as just a new application to something existing or simple. And I think when it comes to bringing people of color into these organizations, into decisions, it goes back to something that Darren said, incentives. We have some firms that are realizing the importance of diversity and are investing in startups and founders that have very clearly outlined diversity objectives and plans. Making that something that is incentivized for these early stage companies and organizations, I think is something that can really shift who is making decisions at some of the largest companies that we know today. Imagine if Uber had a diverse team, when it was the top 5 hires, or the first 5 hires. And I'd like to say, shameless plug, when we think about innovations, new applications to bringing voices of color, I'd like to hope that WeSolve is doing something like that, giving folks a new way to look at talent, to give access to folks who traditionally haven't had access, and using that as a mechanism to move the needle on the actual number of diverse voices that are in the room.
Thank you, Stella and Maggie. And for the audience, I know we're right a little bit past the hour. Thank you for bearing with us. Maggie's going to round us out here in 30 seconds on her closing comment.
I don't know that I'm the right person to end with here, but I think everyone else has said, really, really thoughtful, great comments that I agree with. I guess I would just maybe Starbucks is making debt investments, and structured correctly. I think there are ways to make debt a little bit more patient, just make it a longer maturity, longer tenor debt, and as low of an interest rate as you can. And those are I think really powerful ways to it's not exactly an innovation, but yes, just when you think about structuring these instruments, these investments, just being thoughtful about those aspects as well. So yes, I think debt can be a powerful tool to use, of course, alongside equity investments as well.
Thank you, Maggie. You did perfect. Appreciate it. For everyone here, I want to give a special thank you to Maggie, Stella, Darren, and Thaddeus for their wonderful insights and pushing us to fix our broken small business infrastructure. I want to invite you back tomorrow at the same time, part 2 of our series, which will dig into the role of funders. And so you don't want to miss that. We have representation, and you could see the registration in the chat. But we have representation from Common Future, Chicago Community Trust, JP Morgan, Hispanics in Philanthropy, and the Kauffman Foundation. So another star-studded lineup, building off of the star-studded lineup today. So on behalf of our entire Next Year team, thank you, and enjoy the rest of the day and leading up to the holidays. But we hope to see you tomorrow. And again, thank you for doing your part to address an equitable entrepreneur ecosystem. Have a great one.